In this example, I want us to see what it actually looks like to contribute to a Roth versus continue to contribute to the traditional TSP. So in the first element here, you see that we have our assumptions made. You're in the traditional TSP. You're putting 10% of your pay into the TSP. I've made up some numbers of what you might get in your pay, your COLA, your rate of return. I'm not from the government and here to promise you 4%. I just put a number in so we'd have something to look at. And your beginning balance of TSP in this case, as you see here. So we go out into the future years and we see the traditional TSP growing by your contributions, the government match, and an earnings on the account. So as you can see, $150,000 could become $370,000. Woo, let's do that. Right? So in that amount, though, if we had a total tax, as I illustrated on the previous slide, if we use that tax rate, you would get a net, right? Because like I said, that $300 is not your money, right? It's y'all's money. There's the actual number. If you were able to maintain that low tax rate throughout all of retirement and draw it out over time. You can't draw $300,000 and play that rate, right? Make sure you understand the difference. Okay? So scenario 2, we'll make the same assumptions, but in this case, we're going to save 7.8% instead of 10% of your pay. Why? Because I'm using a 22% tax rate. 10 minus 2.2 is 7.8. You can follow my math if you will. I'm paying out the government first, saving the rest of it. 7.8. I'm saving less dollars, but they're all going into the Roth in this example. So now remember, we still have our traditional TSP with 150 balance. It's still growing by its earnings and the 5% the government's going to place in every pay period as your match. Because we said the government loves you enough to give you a match, but doesn't love you enough to give you a tax-free match. So we see that money would grow to that 270 line. We have a Roth TSP that you've begun contributing that 7.8% of pay. You do that for a number of years. And this bucket now is all the tax-free TSP, Roth TSP bucket. There's no tax to be paid on all this money as long as you play by those rules of being over 59.5 and you've had it for 5 years, so you're in good shape. So by the time I tax the traditional TSP and I have my Roth TSP after tax, hey, wait a minute. That number is actually a smidgen better. Actually, when you do the math, it comes right at it depending on your tax assumptions. Your numbers, if the taxes are the same, there's no difference. Okay, let me say that again. If your taxes are the same now versus later, it's a sum zero gain. If taxes go up later, your Roth is worth more. If taxes go down later, your Roth is worth less. You see the way I brought that scenario up? And so that's an actual scenario in which you could have money that would be maybe of the same value even, but different consistency. And you would have different controls and ability to take money from the different buckets as you see fit.